everyone. I'm Natalia Knyzhevich. I cover the US stock market for Bloomberg, and we have a great panel here, and I think it's a fantastic opportunity to talk about how investors are using artificial intelligence for the investment decision process. I want to start with J.K. Rosner. J.K., could you talk a little bit about what you guys do and what is the kind of composition of your hedge fund platform and how exactly you guys invest?
Sure. Thank you, Natalia. I want to give a big thanks to iConnections for hosting another great event. It's a real honor and pleasure to be here. Thank you to everyone in the audience for being here at the 4 o'clock panel at stage D. It takes, you're here right before cocktail hour, so thank you for being here. Before we get into that, I just want to quote a study I heard recently. When you're on a panel right before cocktails, studies show that only 25% of you are going to focus on the panel. 25% of you start thinking of your to-do list, and 50% of you start thinking about which events you're going to go to and who you want to meet later. The good thing is, no matter what we say, half of you will have really enjoyed today's panel. So I'm at PAAMCO Prisma. We invest in hedge funds. We invest in all hedge fund strategies. The firm is based in Newport Beach, California. I'm on the investment team. I focus on global macro and relative value strategies, and I have other colleagues that look after the equities and credit. We have a platform. It's called Molecule. When we invest in managers, we onboard them on our platform. Everything is external allocations. We don't have any internal trading teams. So we don't compete with the hedge fund managers. It's one of many reasons they like partnering with us, because we don't upsize trades, not pay them, and we have no CIO center book that bumps up against their risk. So they like that independence and no exclusivity. And so that's my main focus, is on global macro and relative value hedge funds.
So, J.K., when you talk to hedge fund managers, what kinds of questions you ask them in terms of how exactly they use AI for their strategies? What's important for you?
Yeah, so when we do the due diligence on the managers, and managers talk about using AI as a tool in their investment process, one of the important questions that comes up is, well, what do you mean by AI? A lot of times people like to throw in these, the fancy common popular terms just to sound more exciting and more sexy. So, in a very respectful way, I ask, what does it mean specifically? Like, give me examples. How is it different from traditional tools in quantitative finance that a lot of people have used for so long? And by the way, there's nothing wrong with traditional quantitative finance. There's still a tremendous amount of things you can do with it. There's so many things that in finance and trading that you don't need AI applications, trend following, factor trades, risk premia, carry-related strategies. You don't need the powerful AI tools for pattern recognition when a lot of these things still work. So I ask managers, specifically, give me the examples of how you incorporate it in your process. I also, talking about data, it's the topic of today's panel involves data as a new alpha. I also like to know what types of data sets does a manager use, whether they're a discretionary based manager or whether they're a systematic manager. We like to know, what are they spending money on in terms of data sets? Just like everyone has a data budget. We want to know, what's the most expensive data set you have, what doesn't work. Sometimes, people, we have respect for people's proprietary process, but, I'd like to know what are you buying, or just tell me some things that you've tested and doesn't work. Kind of always curious about, why it doesn't work. When you apply the data in your process, we like to know, how do you know when it's time to retire that data set? When you identify the alpha degradation, is it that you feel that you've exhausted the capabilities from this data set, or maybe it's just the alpha of your own models have decayed? So, how do you identify that distinction? Is it, the alpha degradation of the data or model? So, these are the questions we ask when people start saying that they're using AI methods in their process.
Understood. Marcus, could you maybe talk a little bit also about your investment profile, what asset classes you typically invest in, and how you guys are using AI, and do you use your own internal tools, or do you guys use some external models?
Sure. First of all, thanks for you sitting here. I think everybody else is losing out because this is the hottest topic, certainly for us, data in alternatives. I work for a firm called FERI, which is just based north of Frankfurt. We run $78 billion for German-speaking institutional investors, family offices. Germany is a very boring place, but still very stable, technology-driven when it comes to 4 wheels and a steering wheel. Beyond that, I think we've been left behind for quite some time. I'm running the alternative investment business, which is roughly 22 billion out of the 78 billion. And we use AI, not in the way that we take it for decision-making processes. So we basically use it to increase efficiency. Efficiency, holding a German passport, is either costs down or you have additional time. That's what we all care about, right? So talking to managers, as Jackie just said, is we want to understand how do you use AI in terms of, is it just a tool for you to increase efficiency? You have more time to do research or to do other things? Or is it really, and we are very close to managers who use AI for decision-making processes. This is at the very edge of where we are currently. We invest across 9 asset classes. And as I say, I'm responsible for the alternative allocation, which covers private markets, hedge funds, and we run our own dedicated vol-up strategy.
What are some of the examples, specific examples, how you guys increase efficiency with AI?
We are currently invested in 310 private market funds and in 53 hedge funds. We get zillions of informations, data, Excel sheets, PDFs, Words, you just name it. Whatever kind of data format you can think of, we get, all in a very heterogeneous way. So historically, we had a bunch of slaves called students in the basement, which we asked to extract the data, punch it into the database before we can run, and this is the title of the panel, risk and subsequently reporting. Reporting is just a derivative of risk analysis. Reporting is if the system is up and running, you hit the button and the report is there. The actual work is the risk, the data cleaning, getting it into the right stack, into the right shelf before you run it. So to answer your question, it is really that we extract information from AI, and I talked to Rich before, but once we have extracted it, it's not a decision-making process. It probably, and Rich estimated us to gain 2 hours a day. If that is the case, and I have measured it, I'm happy. I take 1 hour for myself because I can see my kids an hour early. My wife probably doesn't want that. And the other hour is used for additional research, for brainstorming, et cetera, et cetera. So we use mainly AI in terms of extracting information for creating efficiency, and efficiency at the end of the day is time.
Fair enough. Rich, could you talk a little bit about what kinds of services you provide to your clients?
Sure. So ECI is what we call a modern intelligent service provider. We cover the full stack of technology. So not just traditional MSP services like help desk and cloud, but we have a full cyber offering, which even crosses over into our data and AI practice. So we have well over 100 data engineers and AI engineers working on custom projects for clients. Our DNA is in the financial service space, so we've been around for 30 years, and 85% of our clients are hedge funds, private equity firms, and alternative investment managers.
Let's talk, guys, a little bit more specifically about how AI can improve, let's say, asset allocation process. Jackie, maybe you could talk a little bit about some specific examples, how you guys use AI tools and how it helps you to find alpha.
Yeah, I'd say one of the biggest applications as an allocator comes from document intelligence, being able to sort through just a massive amount of information and data out there so efficiently. That's a huge plus. But another very big important application is just doing behavioral analytics and doing all the behavioral analysis on the managers. Returns are in the past, already happened. But when you analyze, all the risks in a portfolio, whether it's risk factors or crowding behavior or liquidity traps or just looking at any changes in the speed of trading in the manager, or how fast they dynamically hedge when there's regime shifts. AI applications help, AI is very good at identifying patterns. So it definitely helps, this type of behavioral analysis, these behavioral analytics. And that definitely is something that I don't know if it's going to replace qualitative judgment completely, but it certainly helps make everything measurable. And a lot of the alpha from an allocator side is knowing how to manage and interpret the data efficiently, and how to avoid, big losses. And I'd say that is a huge application, the behavioral analytics.
But is AI mainly a source of alpha, or it's more like tool for better risk management?
I'd say it's a combination of both, because a lot of the alpha comes from better risk management. So in being able to identify factor tilts, when you see if a portfolio starts getting more concentrated, when you helps you identify a manager's behavior of, are they cutting risk too early? Are they panicking too late? Did they increase risk after a loss? And so I think it goes hand in hand. The alpha goes hand in hand with, it helps with good risk management tools, will help generate more alpha. So I think you can't separate the two. Yeah.
Marcus, so when you analyze data and market, where you think AI is the most efficient?
From our perspective, the way we try to find alpha, and alpha is briefly into math, the residual of a regression, but not the linear regression. There are far more complex regressions. So using the word alpha for us is biting our tongue, because most of the time there are certain statistical models to basically regress the alpha away, and alpha is a very scarce animal. So once you find it, you want to catch it. The way we try to use AI is that we have our own proprietary systems, which we do program. We have our own engineers, not 100, only 5 in alternatives. And to speed up the development of the system to actually capture factor exposure and alpha is coding using AI. So what we, over the in particular last 2 years, have encountered is that the speed with which we can implement new statistical models, mathematical models to find alpha, again, we don't really believe that there's a lot of alpha, but if there's alpha, everybody's jumping on it, is the speed with which we can implant our new models to basically capture new techniques, statistical techniques. That's where we use it. The efficiency in that is the speed with which we write ourselves academic papers, we read the academic world. If something is funky, which we read in a paper, my guys want to implement it immediately. So the way you can basically use that statistical model in our systems has increased by a mile.
So, but what are some of the characteristics of, I don't know, like markets or environment where AI is the most efficient, like for example, liquidity, frequency of data? So where do you look at when you try to think like how to use AI more efficiently?
It is, as I say, by coding in terms of getting the system and getting the toolbox ready to check for alpha, and then extracting data. I mean, in the hedge fund world, you get a lot of data. If you're lucky, you get weekly estimates, you get 52 data points a year. If you're unlucky, you get 12 NAV on a monthly basis. In private markets, and that's where you have to distinguish, this exercise is much more difficult, because most of the time you get a quarterly report, you get the PDF, you don't get the data. So extracting that data to play around with, you need AI, and once you have it in your system, that's when you can work it. The problem is the data you extract has to be clean. Sometimes it's not perfect. So you have to make sure that the data, as you get it into your database, is correct. Because if you run the machine and you have garbage in, garbage out, right? So the quality of data, that's where it all starts. So we talk about AI, which is actually the machine. But if you feed the machine with just rubbish, it doesn't really work. So we spend a lot of effort on cleaning the data, making sure that it's right.
Yeah, it matters a lot when we look at, especially quant managers. We like to know, who are the data scientists? Where do they reside in the organization? What governance protocols are in place that oversee what they do? And because it's extremely important. I mean, data for the sake of data isn't that useful. It's when you could extract the information from the data and how that affects the process. So that's what we need to understand. Like, what is that governance that's in that firm?
Mm-hmm. So before we talk about how AI could be used in terms of identifying trends right now in this current volatile markets environment, Rich, I also want to ask you about this shift, because what's been happening right now is, if I'm not mistaken, many companies prefer to build, right, their services in terms of versus buying. Like, what's happening and why is that?
I think there's a couple of factors that you're seeing a big shift, right? So traditionally over the last 5 years, you see many organizations going out and buying licensing and using SaaS platforms. I think with AI, you're seeing a couple of factors. The first is security and compliance and IP, right? Your data is really your IP. The context you put on top of your data is your IP. So when you take that information and you begin leveraging third-party platforms to leverage AI, you're moving that data out of your environment, so you lose control of that information. You don't have the same security controls you had when it sits in your environment. You're also moving your IP, the context you put around the data, the intelligence you have, the years of like understanding and investment analysis, how you're building that into your models, you're putting it someplace else, right? So I think people understand that and want to bring the technology to the data. The other piece is, with rapid development, AI allows you to develop very quick. So you could build agents yourself. Providers like us can build them for you at a much lower cost than using a subscription platform, right? And now you also own the IP to those agents, and you can integrate them across your enterprise over time with other systems and data points, right? So it's really about planning for the future, putting the security and compliance around like what you need. It makes sense right now. I think we're in an unusual spot, right? I've been doing this for 30 years. Prior to joining ECI, I was CIO and CTO at several hedge funds. And there was always that build versus buy. You always wanted to build the secret sauce and buy commoditized stuff, but you can now do more of a build approach.
How would you address those concerns that we are seeing right now around software companies, right? We've seen a huge sell-off in the stock market driven mainly by concerns about the sustainability of entire businesses as we see that. AI models are developing really quickly. So what's been happening and how do you see that?
Well, I think the market is kind of caught up with what a lot of technology professionals have seen, which is the coding on some of these platforms have gotten to be very powerful, right? You could take ideas to product documents, technical design, into code and development. You know what APIs look like that are in other systems. You could replicate that. So when you're looking at things like, hey, I might be a small organization, marketing firm, I need a CRM, I could build my own CRM pretty quickly, right, using AI. And that's really starting to compress on some of these SaaS vendors now who had higher multiples previously. May have been some leverage when they were invested in as well, which I think is causing some of the challenges we're seeing in private credit. But there's questions around their recurring revenue viability going forward, right? How much is really sustainable, right? So those forecasts that everyone had built in, now they're starting to question those.
So what types of companies are at risk?
Look, I don't want to start rattling off names and my legal will probably yell at me. But I'll say, look, you have to really think about everyone in the SaaS space holistically, what services they're providing, and is it unique? Like, are they bringing something that is very hard to replicate? Yeah. Right? And are they forward-looking, meaning, look, eventually some of these SaaS vendors do have some really good IP. They're going to have to build and give you agents that you run in your environment, right? That talk to other agents that you have operating in those environments, right? So I think it's about understanding, do they have a forward-looking strategy? Are they bringing something unique to the table that's not easily replicated?
Got it. Let's switch to markets and how we can use AI and different tools and find this alpha. So we see that, yes, we had the sell-off driven by AI names. We have geopolitical uncertainty. We have still uncertainty around the US tariff policy. We see a surge, like really big spike in gold prices. So Jackie, my question is for you. how you guys see the market right now, where you see the biggest opportunities, where AI can also help you guys.
Sure, absolutely. By the way, I'm seeing people standing in the background. I like to see it because I'm going to tell everyone later that this panel was standing room only. So thank you. So markets, I'd say this year is the path of least resistance is still going to be higher. Big picture, financial conditions are pretty accommodative. There's a lot of fiscal stimulus out there between government transfers, tax cuts, deregulation. There's total debt outstanding is massive. It's growing so much. It's for this reason, when you look at our federal debt of 39 trillion and it's growing about $1 trillion every quarter, when you look at that, it's just, there's a lot of stimulus out there. And the president and the administration's leaning on the Fed to cut rates. That's only going to stimulate things more. And companies are still having earnings. So as long as companies deliver earnings and there's still good earnings revision breadth, you see this rally is diversifying away from just straight Mag 7. It's gone into other sectors. So basically the baseline case is just a grind higher. It's a midterm election year. Statistically, it may not be always an easy year, but still it looks higher. There's a lot of strong trends out there still. You mentioned gold. Gold has been something that really woke up in the last 3 years, a favorite topic for me. It's something that is going to continue. There's been a lot of central bank reserve diversification going on for the last 25 years, but especially you see this a big uptick in gold in the last 3.5 years. Doesn't look like it's going to stop anytime soon. The central banks are the biggest buyers on dips. Looks like it's going to continue with geopolitics still as it is, with President Trump sending warships all over the world and total debt outstanding and accommodative Fed and a declining dollar. It just feels that the grind will continue. Retail is not yet overextended. The speculative length isn't that high. Institutional holdings is still a fraction of what it was 15 years ago. So there's all these reasons why, it's a time series. It could do anything. It could sell off 10% and still be bullish. Gold is not a trained seal. It doesn't react the way that you want it to. Last year during Liberation Day, when the stock market dropped 12% in 3 days, gold dropped 5%. It's a risk asset. When things sell off, everything sells off together when people need to sell and raise cash for margin calls. So it's not going to protect you day to day, but as we speak today, things like that, trends will exist. But I think as we like, volatility exists. It's still out there. Global trade war is toned down a bit from last year, but there's still volatility. There's movement. There's, as I mentioned, the rally has spread across different sectors. President Trump is good for volatility, good for trading, good for active management. So we like leaning into positively convex strategies. We think it should be a good year for active management, good for hedge funds, as people are concerned, with the stock market length as it is, and that, bonds may not protect you as it has historically. So baseline, good year, but you never know when the next hiccup could be, the next left tail, but it doesn't seem like anything outrageous. It could be, the Japanese government bond market, people are worried got overextended. Maybe the whole circular accounting within AI CapEx could be make people nervous this year, but baseline higher in a lot of
Quick follow-up question on that. When we have these unpredictable events, such as, let's say, COVID-19 pandemic, tariffs, big turnarounds, huge volatility, which types of strategies do the best? Machine learning-driven AI tools or human-led strategies?
I think all strategies, by definition, are at risk for drawing down. Whenever you have a sudden spike, these exogenous effects, everything is going to be subject to a drawdown. Some people did well, some people navigated well. Human discretionary strategies always have the ability to pull the plug and turn off the machine. If you're not adhering to the system completely, then it's a discretionary strategy. But systems have rules also built in when to de-risk. But sometimes it's too late. Sometimes the regime already shifted. Sometimes you're in a different world, and there could be a deeper drawdown. So I think if I were to say generically, discretionary strategy, systematic, not counting the stat arb strategies that trade very fast, and those have high Sharpe ratios, but like typical future strategies or discretionary macro, usually macro has a higher Sharpe because they get in and out. There's more selectivity when they enter and exit, but they're usually in it together in the meaty part of the center parts of the trades. So to answer your question, I think they both are at risk for drawdown, which is okay, as long as you, the investor, underwrote them for that expectation. But possibly a human could react faster.
So humans still beat machines.
Yeah, with a great,
Yeah.
but still human with quantitative decision tools. Yeah.
Got it. Marcus, based on the current environment, where do you see the biggest opportunities?
Let me stay in hedge funds, okay?
Yep.
Hate to say, but I agree with Jackie when it comes to systematic managers, where most of the time they have a certain long vol service, which, I mean, nobody calls you up in the morning when the markets tank because the guy in Washington or the guy in Moscow does something stupid. But general CTAs, anything macro-driven diversifies. The concern we have is leverage. Because once this scenario hits, the positions which are levered, and Jackie mentioned margin calls, have to be more or less filled in a very quick way. And I mean, margin requirements have been raised. We've seen this over the last couple of weeks, in particular in certain gold positions in China. I mean, retail clients in China can level up 5 times their own positions. So what we are worried the most about is leverage. And leverage usually is with the big multi-strat shops, anything which is close relative value, and anything which is human-driven usually does not run that much leverage. Equity long short, merger arb, anything which is in the event-driven space. You are probably levered 2.5 times. And that is something which we allocate most of the money to, so we try to avoid heavily leveraged strategies just for the reason of, if you look just at gross exposure of the industry, it's the highest we've seen, and that's where we have a certain concern.
I have a final question. I think we have about 1.5 minutes left. 5 to 10 years from now, guys, let's look into the future. Where do you see, I don't know, what can surprise you in terms of how AI can manage things in investments?
Look, I think quantum will be the new AI in 5 years. The pace of trading will probably be 10 times what it is today. You'll need real-time risk management. Technology will be pervasive through every fund, and you'll need a clear strategy around how to keep pace. It's coming, right? It's there already. It'll become more pervasive in 5 years, right? It'll fundamentally change the markets.
Talking about the future, I mean, it's always hard to predict the future, but the only thing I do know with certainty is gold is going higher. No, I'm just kidding. But I could say in terms of the AI applications, number one, the future is going to be more continuous. Due diligence will occur on a continuous spectrum as opposed to at discrete periods. As opposed to now people look at whether it's daily or weekly returns or monthly phone calls or quarterly letters or annual operational due diligence visits. As information comes in, it gets added into the process with AI tools. And so I think in the limit, it's just going to become, move from discrete to continuous. And the other thing, as I mentioned before, the behavioral analysis is going to help a lot. The behavioral analytics is going to enhance qualitative decision making, and just being able to measure these behaviors is just going to get better over time. Yeah.
I remember when I worked in London 25 years ago, people talked about the TMT and the .com coming in, old economy and new economy. At the end of the day, the .com morphed into the old economy and was part of the economy. In 5 years, AI will be part of the broader economy. Everybody will have either their own model or Rich provides new model or whatever. Everybody will have this and it will be just absolutely normal. I honestly, and this is my personal opinion, believe that as we've seen it over the last 20 years, that inflation, because of this efficiency creeping in, will be subdued. The ability to raise prices, to go through and say, I can do better than others, I think it's going to be limited because there is this intelligence there telling you you're not. Because give me 48 hours and I will tell that I can do better. And I think this is an element which we will see across the globe, that inflation will be majorly subdued. We see it right now, at least for the next decade or so.
Thank you so very much. It was a really great opportunity to talk to you. Thank you so much, everyone who joined this session. Thank you.